Welcome back to FT Markets. Share buybacks are big news in the US. Companies such as General Electric and Apple are looking at their cash piles and handing it back, a lot of it back, to shareholders. Some companies are borrowing in debt markets to give money back to shareholders. But will this trend spread to Europe? And if it means companies are skimping on investment, is it going to be good news? With me to discuss all this is Nick Nelson, who's the European equity strategist at UBS. Nick, welcome to the Financial Times. Let's just talk about what the trends have been in recent years. We've got a very nice chart here showing the scale of share repurchases as a percentage of market capitalization on both sides of the Atlantic. What's been the story since the crisis years then?
Sure, so you can see quite clearly in the US, the red line here, we've actually had some decent pickup in buybacks from the crisis to running at about a 3%.
It shot
level.
up during the crisis, but that's partly because market cap collapsed.
Exactly. It's just part of that sort of statistically. But since then, we've seen about a 3% run rate, which is about triple what we're seeing here in Europe, running at just 1%.
So what's been driving it in the US, do you think? We're much higher than we were sort of a decade ago.
Exactly. So I think in the US a few things are different. One, the economic cycle is obviously further involved than we are in Europe. Two, CEOs have got a bit more confidence than they have. And three, the market has rewarded companies that bought back shares. I mean, if you look in Europe, highly geared companies have underperformed, but in the US, highly geared companies are doing better.
So if they buy back their shares, then the price goes up, and that feeds into their pay packets as well.
Exactly.
We should come back to that point as well. So, but why is it so low then in Europe?
Well, I think in Europe there's been a few headwinds. Firstly, we've had 2 recessions in 5 years. Secondly, there's been this risk of exactly, and there's been this risk of deflation. And I think if you have this threat of deflation, the last thing you want to do as a company is re-gear your balance sheet going into deflation. Okay. That's an absolute disaster.
The question now, might that trend change? Might that start? We see that those European figures start to pick up.
Well, we would expect so. We would expect so. Well, partly because if you look at leverage, that's fallen very dramatically for European
We've
companies.
got a chart actually showing the leverage. Europe versus the US. What's the point you're making with this one?
Sure, so we can see basically that the US, the blue bars there, have been re-gearing quite gradually since 2010.
The blue line's going up.
Yes, exactly. And here in Europe, the red bars, we really haven't re-geared at all. And in fact, if you look at leverage, it's close to a 15-year low. So in Europe, companies are very undergeared.
In other words, they can buy back equity and they can even increase debt and still keep those leverage ratios within reasonable limits.
Precisely, and it's very cheap for them to do so. If you look at investment grade non-financial corporate credit, the yield's about 1%, and the yield on the equity is 3%. So it's definitely cheaper for companies to issue debt and buy back shares.
But there are sort of big cultural differences as well, aren't there, across the Atlantic, which will hold back, I would have thought, equity share buybacks on this side of the Atlantic?
Yes, I think in the US it's far simpler to do a share repurchase scheme. In Europe you have to get permission for each tranche as you do it and go back to shareholders every time you need to buy shares. Culturally in Europe we're much more used to dividends and much less used to share buybacks. So there's a cultural difference at work.
And also less likely to have executive pay linked to earnings per share, which is obviously affected by buybacks.
That's true. And if you look at the US earnings per share, you've seen about 7% EPS growth in the last 5 years per annum. And almost half of that, 3 percentage points, has been because of buybacks.
So what's your expectation? Do you think we're going to see more European share buybacks?
Yes, I do. I think we'll see an increase in dividends, and I think we'll see an increase in buybacks. And then later in the cycle, we might start to see CapEx and M&A.
But not as dramatically perhaps as in the US?
No, and if you look at M&A, for example, in Europe, M&A, the gap between European M&A and US M&A is the biggest since 1998.
Okay, that's another thing we could go into another day. Last question, the big question. If companies are buying back their shares, is this good news long-term for the economies?
Well, look, I think in the short term it's good news for the stock markets, but as you sort of hint to, it's not necessarily good news for the economy. What we need to see is some investment. So CapEx as a ratio of sales in Europe is close to a 25-year low. So companies have not been investing. I would suspect we see something more defensive, like share buybacks and dividends first, and then secondly, we start to see CapEx.
Nick, thank you very much. So possibly a pickup in European share buybacks, perhaps as a precursor to a pickup in mergers and acquisition activity, and maybe even in investment.